Thank you everyone for listening so much content so far. I will not take much time between you and the coffee break, so I will make it quick. So let's start with the motor trend. I'm also covering the same pattern. We are going with the same pattern between KSA and UAE for the motor benchmarking. So I will be covering the business mix, average tariff, burning cost, combined ratios, and then in the last I will cover the SNS and a few as high level analysis on NCD. So going forward, this for the summary right now, overall KSA market business is 52 billion. However, if you compare it to the UAE, it's 29 billion, where KSA with the 26 companies and UAE is with the 29 listed companies. Apart from that, if you just have the KS motor itself in the KSA is 10 billion plus market, which is more than around, if you roughly calculate with that's the 30% of the total UAE market, and it is untapped right now because the regulation over there is not that much strict to have that, because it's not like in UAE you have to renew the car every year for the insurance. But in KSA, the regulations right now is implementing and imposing more fines on the vehicle those are not insured. And in future, like for the slide, I will go through that how we can see the impact change on those. So going forward to the business mix, if you look at the business mix for the KSA to UAE, just to clarify from there onwards in the slides, the shaded ones are the KSA and the full ones are the UAE, representing to the UAE. So if you look at the business based on the premium, you look at the UAE is more or less heavily comprised with the CP, and the KSA also have the more or less similar for the 2021 and 2022 at the more or less even in the both CP and TP. But if you look at the exposure side, Saudi side is more heavily relied on the TP right now. It's more than 70% over there. We have the TP business, and on the other side, on the exposure wise is in the UAE CP is for the 2022 UAE is more evenly 50-50 for 45% for both segments. Again, the same thing which I mentioned earlier, that this is because of the regulatory impact. In future, we can say the different proportion in 2023. Right now, it's just recently for the 2 months before they have implemented the change in the fines and the imposing that the non-insured vehicle to be insured in certain time frame, and otherwise the fines will be imposed. So that proportion will be changed, like we can say more or less similar to this one, but it's not about that the business will be same, it's just about the exposure. Now moving further, if we look at the body type wise mix, UAE and KSA more or less similarly relying on the three major types: saloon, 4x4 and pickups. The other body types like equipment, heavy equipment, light equipment, those are less than around 10 to 13 14% of the total mix, but they are heavily relying on the first two part. And if further break down, the first two parts, saloon and 4x4 are the more contain the major portion of the total business. This is for the CP, and and now so for the further slightly deep down into CP as well for the agency on the repair condition. In Saudi, they are more emphasizing on the agency business rather than the non-agency business compared to the UAE one, where we have more non-agency businesses rather than the agency one. And so, going to the TP one, TP is again same proportion as compared to the body type. We have more highly concentrated saloon and 4x4 rather than the other body types. So this is the compared to the business mix, the proportions of the like saloon and 4x4 are similar to the both region. However, the exposure of KSA is very much high in compared to that one. We'll look into the further slide. So before going to the average tariff, I just need to emphasize on the pricing review and the pricing methodology, which is different between both regions. In UAE, we being a consultant and actuaries, we do the pricing review, only the rates which is already being charged by the company. We look at that at a level of the burning cost and then analyze how much they need to increase or decrease on the rates. However, on the flip side, on KSA, the rates charged by the appointed actuary were implemented on the base of the company's own portfolio. Each and every company have their own set of portfolio. Based on that, they price and they charge it, whatever the situation is, regardless of right now the expense ratio. Each company has their different expenses. Bigger companies have a low expense ratio, similar to the smaller one. So if you look at the TP one right now, 2022 was a COVID year, that was a different story. Then 2022, more or less, both industry was on the same level. But since in KSA, frequently the trades were like monitors and changes were made, you can see the improvement in the rates. But overall, on the other side, even though the rates are loss ratios increases, the rates still remain the same throughout the year, because that is already been charged, and no frequent changes were made on this one. So the increasing trend in the case is based on that regular changes made in this one, and the difference is more or less is driven by the expense ratio, which we see in the later slide. But right now for the UAE also, the green line shows that we are expecting the increase in the tariff for 2023 onward. Similar to the CP, if you look at that, in 2021 they are more or less on the difference was minimal, but now they have increasing trend. But KSUAE is still on the same path. There is not much increase we have observed over the year, though the loss ratios are also having some increase in this one. But for the 2023 we observed there is slight increase. We are observing that, yes, now from the recent pricing exercise were done, they have most of the company we suggested based on the review that it need to be increases. Okay, just one analysis based on the agency 4x4. We have just accepted few that if you look at the Nissan petrol over there, the KSA has a higher average than the UAE. There are few outliers in the UAE as well, which we see at the top. But the average line, if you look at the middle one, that is around 3,700 for KSA and for 3,200 for UAE. But on the other side, if you look at the Land Cruiser one, the average is more or less similar, but the highly concentrated UAE on the lower side, rather than KSA, which have a small bracket of 3,200 to 3,600. This is for the CP and agency. This is specific type of vehicle we have put it as for example. Now for the burning cost, we have already seen trend. The difference between the trend between the CP and TP between two regions is, as I already said, is because of more of the expenses. But if you look at the burning cost, that for the TP, it's also showing the same. The exposure, if you look at as I already mentioned in the beginning, that the UAE KSA market is very much, it's very big compared to this one, and is already untapped right now for the significant portion, which as per our analysis in the recent industry report, which you can see in the KS industry report, which we published that recently after the regulation, which just published a few months ago, there's significant increase in the insured vehicle. We have seen around 180% and more. So that proportion will change. So this is the trend for the TP burning cost right now. Still, you can say that the trend we see in the tariff, it's still reflecting the same trend we see in the burning cost for the claim cost for TP. Similarly, in this one, the increasing trend seen in the CP is also reflecting the same, the tariff impact. And again, emphasizing on the same part, the timely change and a proactive approach rather than the reactive approach in the pricing rates in the KS industry compared to the others one. So now, a bit further, we move further to the loss ratios. If you look at the loss ratio, the UAE loss ratio is right now at the 96% for compared to the 2021, and KSA one is at 90%, which is lower than one. But if we compare to the prior year, that is an increase from the previous year. So the impact is also shown in the trends as well. Expense, yes, the expense ratio for CP in UAE is much higher than the KSA one. The KSA one we have taken from the industry report, the analysis published by SAMA. So that is weighted average of the whole industry, rather than the one which is for the UAE is based on our database which we have, because this is not the public information we can extract for. So this is solely relied on those ones. So based on that, the weighted average market is 19. However, UAE is a bit on a higher side. That's why we see the differences in the rate. And that similar commission is more As in a similar. For the TP, this is the combined ratio, sorry, for that one. This is for the combined ratio. Combined ratio is still UAE is on a higher side and it's stand on 132%. However, KSA is on 124%. We are at still above 100%. So most of it, if we are going in the IFRS 17, you will be having the loss component for these ones as well. So now for the TP part, yes, KSA has a bigger chunk. That's why they have more exposure and more. We have more data for that one. It's still on higher side, but yes, TP in 74%. We can say it's okay, but it's similarly following the previous year trend for this one. But if you look at the KSA market, like is following the same pattern which we have seen in the trend that well, they're increasing the losses, so they are proactively exchanging the rates according to the market changes and the inflation if they are impacting that one. For the expenses, still for the TP as well, if you further break down, it's on the higher side than the KSA market. I'm just moving a bit further for this one. Yes, again, since the loss ratio is a high, expenses even though high, but the difference between the TP and CP for the KSA and UAE is still significant between this one. That is mainly driven by the loss ratio which we have seen earlier for KSA and UAE. Okay, so further moving to the next one, say the solvency of SNS. If you look at the UAE one is higher than the KSA one. This is one of the main reasons. Again, the regulatory requirement for in the KSA is that prior to the 3 year they have to write off the SNS settlement subrogate. But still we have in the KSA in the UAE market, what we have received the data, we still found out in our data that they are still 3 year, 4 year, 5 year prior. SNS outstanding or booked for them. As far as the outstanding, I know sometimes we see the outstandings are highly booked, overly booked. So as far as you are receiving back those, then that is fine. Otherwise, until it reflects to the from the IBNR when we are setting up, then we need to write it off. So this is the trend. If we follow the same regulatory writing of the prior recoveries, there might be on a similar trend for this one. This is for the CP only. Okay, now the NCD right now recently, as Usman also mentioned about the regulation that is called off for 50% discount in the UAE, but this analysis is based on that till then 2022. So we have seen that now that the pattern will change, but compared to the NCD which KSA offers. For different NCD 1 represents 10% to 20, 30, 40 and 50 plus. The maximum is 50, which is offered by the KSA. So if we look at the CP analytic trend, that is more or less similar, and then the majority of the chunks don't have any discount because of either they don't apply, they don't know, or they have some accidents over the past 1 year. But if we look at the TP, that shows other way around picture. Because of that is mainly driven by the regulation that is not that the 50% discount can be applicable on this one, so that is applied on those. So this is one portion which might change over the period after this removal of this regulation, which is just recently removed. So now just taking 1 minute more on regulatory comparison on this one. There are different regulatory comparison between KSA and UAE. If you look at the first thing, that the pricing methodology which is used right now, which I said earlier that still we are doing a pricing review in QA rather than pricing rate making, you can say that in KSA, which is more advanced is GLM. And regulatory requirement is once a year for both in KSA and. But minimum factor means the engine type, make, model, and what we are using right now to analyze. In KSA, in UAE, it's only 4 factors we are right now using to analyze this. So 4 or maybe sometime it's 5, depending on what further deep down analysis you want to do. But in KSA, there are 13 and 11 factors mandatory by the regulatory to use and record. But the data, if there is no, then you have to discuss with the company how to improve that data requirement. Minimum requirement for the minimum premium for assigned by the CBUA. However, in the KSA, that is based on the portfolio to portfolio basis of the company, and then where we decide at what level the minimum should be set. It should be within the range of the market. Like you should not be much at the lower, so that you will be having the bad business in your books. So expense loading, again, finalized internally within the company. There is no influence as such or appointed actual or any regulatory requirement to just mention. But however, in the KSA, there is a certain pattern we take as a business plan loss ratios, current company's loss ratios, motor separately and motor business. There are 3-4 types of the business pattern which we calculate, and then we had a discussion with the board, and then we select what expense ratio, profit and commission ratio will to be mainly on the expenses. Pricing advocacy, which Zahir also mentioned on this, on the question of the gentleman, that this is one thing which is more frequently asked by the SAMA and very strict on this one too for the submission, that requires after end of the every quarter we have to add how much what rates appointed actually given to you and at what rate you are selling. So if you are giving excess discount, then it means you are not meeting the minimum loss ratio at which the price were driven. So on the other hand, in the UAE, there is no such regulation for to do the quarterly advocacy or submission for the pricing, which we have. In fact, it's a review, so it's one time. That's kind of a review which we do normally once a year in UAE. And expense allocation, again, the expenses which we decide the once a year, after the end of the year, even then the pricing is done in May, and the end of the year there's an expense allocation exercise which we do normally for the KSA. So that allows us to know that what the expenses we use at the time of the pricing, is it still valid or not. After it's kind of mid-year exercise, but in UAE there is no as such right now requirement for this one. Just one mentee question for this one: how frequently the company amending the rates in your company? So just to have annually means the once a year, which it is regulatory requirement. Just give me a few seconds. 6 responses. Okay. I'm assuming those quarterly ones are Saudis because we have some Saudi guests also. Okay. I should put region also in this one. Okay, fine. So more or less, if you see that the few of the companies are still doing quarterly, or monthly ones are really, really good, if any, those companies who are doing monthly, but annual ones are still need to more focus on this one, because they're directly related to the portfolio performance. If you are just relying on the ones set at the beginning of the year, the portfolio, the dynamics, everything changes, then you have to be proactive on this one. Okay, just final slide for this one. Just few suggestions on the regulatory side, that what we need to do for pricing methodology in UAE, we have to move on a more specific, sophisticated pricing methodology like GLM. And similarly, already KSA have GLM, but we can move towards the all four for the like random forest and more predictive analytics methodologies, which we can adapt to. So for the factors, yes, need to start using more factors. And for KSA, we are already relying on the minimum cutoff, that this is the 13, then it's okay. But as Sama also instructed, that we have to move a bit further step ahead and record more. And if I just mention telematics over there, that telematics will help us to analyze the behavioral impact of the driver. Like we have, I guess you guys have seen pay as you drive campaigns from few of the companies. So this is how that further information can allow us to make new type of products that helps you to pay less and make your sum insured more. That depend on the data what we have. So for increasing frequency of rate adjustment, like we said that right now we have 37% of the companies who are not doing the rate adjustment on the quarterly basis, that is required, because they're monitoring your portfolio and adjusting the rates. It's very useful that we have seen the changes in the portfolio performance over the year, that if someone is lying on the 95, 99, 100% loss ratio, by amending or changing the ratio according to the portfolio different dynamics, if someone is moving towards sedan 4x4 to the pickup and vans, then it need to be changed, that because the initial rates were based on your initial portfolio mix. And allocation of expense, again, allocation of expenses need to be adjusted according, because you need to, not quarterly, but it has to be on a biannually basis or commuter. You have to analyze. You don't need to change it, but at least you have to know that where you stand at the beginning when you are applying those. Because if you keep on continuing on this, you might have losing a business because of the high expense rates or because of expenses. Just final comment that based on the Zahir's presentation and mine, the final conclusion, what is a smart choice to do? So, the smart choice will be buy medical insurance from KSA and motor from KSA. So that will be the smart choice. Thank you everyone. Thank you all your time.